a financial journey for over 125 years. Over the past 10 years, we have seen headlines about crashes, booms, bubbles, and recessions, and it can be enough to make anyone want to stuff their savings under a mattress. But I want to invite you on a journey. A journey back in time, over the last 12 decades, to see the story of the global stock market unfold. We're going to take it 10 years at a time. We'll see what the world was like, what drove the economy, and how the market behaved. We'll meet the corporate giants of each era, and we'll witness some truly breathtaking storms and some glorious sunshine. The point of this history lesson is not to make you a walking encyclopedia of financial dates. The point is to show you one simple, powerful truth. Through world wars, depressions, pandemics, and technological revolutions, the enduring engine of human enterprise and progress, as represented by the stock market, has always moved forward over the long term. And it has done so by constantly renewing itself, shedding the old and embracing the new. So, get comfortable. Let's take a walk through time. The dawn of the century, the 1900s. Imagine the world in the year 1900. There are no airplanes in the sky. The automobile is a rich man's toy. The telephone is a novelty. In the United States, the average life expectancy is only about 47 years. The stock market of this era was a very different beast. It was not for the everyday person. It was a playground for industrialists and tycoons. The dominant theme of this decade was industrialization and consolidation. This was the age of trusts and monopolies. Giant companies were formed by merging many smaller ones, creating behemoths that dominated their industries. The market moved steadily higher for much of the decade, fueled by this industrial boom. The companies that ruled the roost were the titans of heavy industry and infrastructure. United States Steel, founded by J.P. Morgan by combining the holdings of Andrew Carnegie and others, it was the world's first billion-dollar corporation. It was the symbol of American industrial might. Standard Oil, John D. Rockefeller's empire controlled almost all oil production, refining, and distribution in the country. It was the Google of its day in terms of market power. American Tobacco. This company consolidated the tobacco industry, controlling the market for cigarettes, cigars, and chewing tobacco. The railroads were also massive players. Companies like New York Central and Pennsylvania Railroad were the equivalent of today's internet and shipping giants. They were the essential network that made all other commerce possible. Then, in 1907, we had our first major event, the Panic of 1907. A speculative bubble concentrated in New York banks burst. The stock market fell nearly 50% in a matter of weeks. It was a classic bank run. The hero of that story was the financier J.P. Morgan, who literally locked bankers in a room until they agreed to pool their money and bail out the system. This panic was so severe it directly led to the creation of the Federal Reserve a few years later to ensure no single individual would ever have to shoulder that responsibility again. The decade ended with a powerful lesson. The market can be volatile, but industrial progress was an unstoppable force. The teens, war and recovery. The 1910s were dominated by one overarching grim event, the Great War, what we now call World War I. The theme for the market was war and its aftermath. The war began in Europe in 1914, and when it did, the London Stock Exchange actually shut down for months. The New York Stock Exchange, sensing an opportunity, stayed open. For the first time, New York began to challenge London as the financial capital of the world. The war was a horrific human tragedy, but it supercharged certain industries. The market was turbulent, swinging wildly on war news. The industries that boomed were the obvious ones: steel, chemicals, explosives, and shipping. Companies like DuPont, which made gunpowder, saw their fortunes soar. The United States entered the war in 1917, and the government basically took control of the economy. After the war ended in 1918, there was a brief, sharp recession as the economy transitioned from wartime to peacetime production. But then, a powerful recovery began. The 1910s were a brutal decade, but they set the stage for one of the most vibrant periods in market history. The Roaring Twenties. The Roaring Twenties. This is the decade everyone pictures with flappers, jazz, and Model T Fords. The theme was mass consumerism and speculation. It was a golden age. The economy boomed. New technologies were becoming accessible to the average family. The automobile was no longer a toy, it was a necessity. And the king of this new industry was, without a doubt, Ford Motor Company. Henry Ford's innovation wasn't just the car, it was the moving assembly line which slashed costs and put America on wheels. General Motors was its fierce competitor, innovating with different models and annual style changes. But the auto industry created a ripple effect. It spurred demand for oil companies like Standard Oil of New Jersey, Steel US, Steel Again, and glass. Another transformative technology was radio. Companies like Radio Corporation of America, RCA, saw their stocks skyrocket. For the first time, the average person was listening to the same news and entertainment, creating a mass culture. This was also the decade when the ordinary American truly discovered the stock market. People could buy stocks on margin, putting down only 10% of the price and borrowing the rest. It was a powerful engine on the way up. And the market went up and up and up. It was a spectacular bull market. The feeling was that the good times would never end. The stock market became a national obsession. But as we know, all parties must end. The decade closed with a thunderous crash. In October of 1929, the bubble burst. The market peaked in early September and then began a slow, then violent descent. Black Thursday, followed by Black Tuesday, saw the market lose staggering amounts of value. The Dow Jones Industrial Average would eventually fall almost 90% from its peak. The Roaring Twenties taught us about the incredible power of innovation and consumer optimism, but also the profound dangers of excessive speculation and leverage. The 30s, the Great Depression. The theme for the 1930s can be summed up in one word: survival. The stock market crash of 1929 was not the cause of the Great Depression, but it was the opening act. A series of policy mistakes, bank failures, and a collapse in global trade turned a market crash into a decade-long economic catastrophe. The market didn't just fall, it stayed down. If you had invested at the peak in 1929, it would take you until 1954, 25 years, just to get back to even. That's a long, long time. There were rallies, of course. In 1933, the market rallied over 100%. But these were bear market rallies, false dawns in a long, dark night. The companies that did well were the ones that simply survived. The giants of the previous era, like U.S. Steel and GM, saw their businesses crumble. The government response was immense. President Franklin D.D. Roosevelt launched the New Deal, creating programs and regulations that still shape our lives today, like the Securities and Exchange Commission, SEC, to regulate the stock market, and the Federal Deposit Insurance Corporation, FDIC, to protect bank deposits. It was a brutal lesson in economic risk. But for the long-term investor, it underscores a critical point. Even the worst economic period in modern history was ultimately a valley from which the market eventually climbed to new, unimaginable heights. The 40s, war and rebuilding. The 1940s were another decade cleaved in two by World War. The theme was total war and post-war boom. The first half of the decade was dominated by World War II. Once again, the market was volatile, but the outcome was never in as much doubt as in the First War. The American economy became the arsenal of democracy. Companies like General Motors stopped making cars and made tanks and airplanes instead. Boeing became a household name with its B-17 Flying Fortress. Alcoa ramped up aluminum production for aircraft. The entire economy was mobilized. A fascinating point, the stock market actually bottomed in April of 1942 when the war news was still very bad, and then began a steady climb. The market, as it often does, was looking past the immediate conflict to the peace and prosperity that would follow. And what prosperity it was. After the war ended in 1945, the world was in ruins, except for America. Its industrial base was untouched and stronger than ever. There was pent-up demand for everything: houses, cars, appliances. This launched a massive bull market. The GI Bill sent millions of veterans to college and into new homes, creating a vast, educated middle class. The companies that dominated were the old industrial giants, but they were now feeding a consumer hungry for a normal life. It was the calm, prosperous dawn of the American century. The 50s, the happy days. The 1950s were a time of quiet confidence and growth. The theme was stability and suburbanization. The war was over, America was the undisputed global leader, and the economy was humming. The Cold War began, but for most Americans, life was focused on the family and the new suburban dream. The stock market reflected this stability. It was a steady, powerful, and consistent bull market. This was the era when the cult of the equity was born among institutional investors. People began to trust stocks again. The dominant industries were those building the suburbs and filling the new homes. Automobiles, the big three, General Motors, Ford, and Chrysler, were at their absolute peak, producing the iconic tail-finned cars of the era. Oil, as America took to the road, the demand for gasoline exploded. Companies like Exxon, Mobil, and Chevron were giants. Chemicals and conglomerates, companies like Dow Chemical and DuPont, better things for better living. Through chemistry were innovators. It was also the era of the conglomerate, where companies like IT&T bought everything from insurance companies to bakeries. IBM was becoming a force. It dominated the business of tabulating machines and was laying the groundwork for the computer revolution. It was a golden age for the blue chip investor. Buy a piece of GM, hold it, and watch it grow. The lesson of the 50s was the power of steady, predictable growth and the rewards of believing in the American economy. The 60s, the go-go years, and the nifty 50. The 1960s were a decade of social upheaval, but for the market it was a time of growth and speculation, reminiscent in some ways of the 20s. The first half of the 60s was a strong bull market. President Kennedy introduced investment tax credits, which boosted corporate profits. But the latter part of the decade saw the rise of a new kind of speculation. This was the era of the conglomerate boom, where investors fell in love with companies that grew through endless acquisitions. It was also the time of the go-go years on Wall Street, with performance-hungry fund managers chasing the next hot stock. The most famous market phenomenon was the Nifty 50. These were 50 large-cap stocks on the New York Stock Exchange that were considered so high quality and such dependable growth machines that you could buy and hold them forever. They were called one-decision stocks. The list included iconic American companies like IBM, Xerox, Polaroid, Coca-Cola, Procter & Gamble, and Johnson & Johnson. The problem was investors pushed their prices to astronomical levels. At its peak, Polaroid traded at a price-to-earnings ratio of over 90. The belief was that these companies were invincible. It was a bubble in blue-chip stocks. The decade ended poorly, with a recession and a bear market taking hold. The lesson was clear: no company, no matter how wonderful, is a buy at any price. The 70s, the great stagflation. If the 50s were happy and the 60s were go-go, the 1970s were miserable. The theme was stagflation and crisis. Stagflation is that awful combination of stagnant economic growth and high inflation. It's a killer for the stock market. Why? Because rising prices hurt consumers and companies, but the stagnant growth means they can't raise prices enough to keep up. It's a vice. The decade was a parade of bad news: the collapse of the Bretton Woods monetary system, the Arab oil embargo of 1973, which sent gas prices soaring and created lines at the pump, and a second oil shock in 1979. Political crises like Watergate eroded confidence. The stock market went nowhere for the entire decade. If you adjust for inflation, it was a disaster. The real value of the market was cut in half. So, what worked? The only things that worked were commodities. Oil companies like Exxon did okay, but the real stars were the companies that owned hard assets. It was also the birth of the NASDAQ exchange, which would later become a powerhouse of tech. The Nifty 50 stocks from the 60s were crushed. Many, like Polaroid and Xerox, never reclaimed their former glory. The 70s taught a humbling lesson: the market is not immune to the broader economy, and inflation is one of its most formidable enemies. The 80s, the bull is born. The 1980s were a dramatic reversal. The theme was deregulation, disinflation, and the dawn of tech. The decade began in a deep recession, but the Federal Reserve, under Paul Volcker, brutally raised interest rates to wring inflation out of the system. It was painful, but it worked. By the middle of the decade, inflation was tamed, and a new powerful bull market was born. It would become one of the longest and strongest in history. This was the era of the corporate raider and the leveraged buyout. It was also the era when Japan's stock market boomed, briefly making it the largest in the world. The dominant industries were shifting. Finance, with deregulation, financial companies like American Express and Citibank became market leaders. Consumer brands, companies like Coca-Cola and Philip Morris, had fantastic runs as global brands became more valuable. Technology, this was the true beginning. The personal computer revolution took off. And two companies came to define it: Microsoft with its MS-DOS and then Windows operating systems, and Intel with its microprocessors that powered those PCs. The Wintel duopoly was born. Then we had a stark reminder of risk. Black Monday, October 19, 1987. The Dow Jones fell an almost unbelievable 22.8% in a single day. There was no major news to cause it. It was a crash driven by portfolio insurance and panic selling. But unlike 1929, the system held. The Fed provided liquidity, and the market recovered with astonishing speed. The bull market resumed. The lesson of the 80s was that conquering inflation could unleash tremendous animal spirits, and that a new technological age was beginning. The 90s, the dot-com frenzy, the 1990s were a decade of irrational exuberance. The theme was the Internet revolution and globalization. The bull market that started in the 80s turned into a spectacular sprint in the 90s. The collapse of the Soviet Union seemed to herald a new era of global peace and American dominance. The rise of the Internet promised to change everything. The early part of the decade was solid, led by the companies that built the information superhighway, like Cisco Systems, and the ongoing dominance of Microsoft and Intel. But then, around 1995, with the Netscape IPO, mania took over. The phrase .com became magical. Any company with a com in its name could raise millions of dollars without ever having made a profit. The old rules of investing, like looking at earnings, were declared dead. The NASDAQ index, home to most tech stocks, went parabolic, rising over 500% in 5 years. New giants emerged like Amazon and eBay, but they were dwarfed by the sheer insanity of companies like Pets, Com, and Webvan. The old economy stocks, the so-called bricks and mortar companies, were left in the dust. It felt like a new world order. But trees don't grow to the sky. In March of 2000, the bubble burst. The NASDAQ began a long, sickening slide, falling almost 80% over the next 2.5 years. Countless dot-com companies went bankrupt and vanished. The 90s taught us a lesson as old as the tulip mania. Technological change is real and powerful, but no technology suspends the laws of economics and valuation. The 2000s, the lost decade. The 2000s were a brutal roller coaster. The theme was crisis and resilience. The decade started with a hangover from the dot-com bust. Then, just as the market was recovering, the September 11th attacks in 2001 created a new wave of fear and uncertainty. The market found a new bubble to inflate: housing. Fueled by low interest rates and complex, poorly understood financial instruments like mortgage-backed securities, a massive housing bubble grew throughout the decade. For a while, it drove the market higher. The new giants were financial firms like Lehman Brothers, Bear Stearns, and AIG, and energy companies like ExxonMobil, which briefly became the most valuable company in the world as oil prices soared to an all-time high. Then, in 2008, it all came crashing down. The global financial crisis was the worst economic crisis since the Great Depression. Lehman Brothers failed. The entire global banking system teetered on the brink of collapse. The stock market fell over 50% from its peak. But then, something remarkable happened. Governments and central banks around the world intervened on an unprecedented scale. They bailed out banks, slashed interest rates to zero, and launched quantitative easing. It was the opposite of the policy mistakes of the 1930s. The market bottomed in March of 2009, and a new bull market was born. The decade ended with the S&P 500 almost exactly where it started, a lost decade for investors. But the seeds for the next boom were sown in the ashes of the crisis. The lesson was harsh. Leverage and financial engineering can create catastrophic risk. But the other lesson was that decisive policy action can prevent a total collapse. The 2010s, the everything boom. The 2010s were the mirror image of the 2000s. It was a decade of almost uninterrupted, powerful, and surprisingly calm growth. The theme was FANG and unicorns. The bull market that began in 2009 just kept going. It became the longest in American history. The economy recovered slowly but steadily, and interest rates remained at historic lows, making stocks the only game in town for yield. This decade was utterly dominated by technology, but this time it was profitable technology. The acronym FANG entered the lexicon: Facebook, now Meta, Apple, Amazon, Netflix, and Google Alphabet. These companies didn't just change the stock market, they changed how we live, work, shop, and communicate. Apple became the first company to reach a $1 trillion market value, then $2 trillion. Microsoft, written off after the dot-com bust, staged a stunning comeback under new leadership. The top of the market was no longer oil and banks. It was a handful of tech platform companies. It wasn't entirely smooth. There was the taper tantrum in 2013, a sharp correction in 2018, and rising trade tensions. But every dip was quickly bought. The market's resilience was remarkable. The lesson of the 2010s was the power of platform business models, network effects, and the sheer scale of the digital economy. The last 6 years, a pandemic and a reckoning, 2019 to 2025. Now, let's bring our journey right up to the present. The last 5 years have felt like several decades compressed into one. It started strong. 2019 was a great year, a continuation of the 2010s bull market. Then 2020 brought the COVID-19 pandemic. The world shut down. The stock market experienced the fastest bear market in history, falling over 30% in a matter of weeks. It felt like the financial crisis all over again. But then something even more astonishing happened, the fastest recovery in history. Governments unleashed massive fiscal stimulus, and central banks flooded the system with liquidity. The market not only recovered, but soared to new all-time highs by the end of the year. The companies that thrived were the tech giants, who enabled the remote work and stay-at-home economy. And of course, pharmaceutical companies like Pfizer and Moderna, who developed vaccines at record speed. 2021 was a blow-off top, a frenzy of speculation, this time in meme stocks like GameStop and in cryptocurrencies. It was dot-com mania all over again. In 2022, the bill came due. Rampant inflation, which everyone thought was transitory, proved stubborn. The Federal Reserve began aggressively raising interest rates, something no investor under the age of 40 had ever seen. The bull market ended. It was a painful year, with both stocks and bonds falling significantly. 2023 saw a surprising and powerful rally, led once again by a narrow group of technology stocks, this time cantered on artificial intelligence. NVIDIA, a maker of the advanced chips needed for AI, became the poster child of this new wave. 2024. The market is gripped by two powerful forces: the breathtaking promise of artificial intelligence and the stubborn persistence of higher interest rates. The central question for us all is whether AI is building a new world or just another castle in the sky. And as we look back on 2025, the market continues to grapple with the same fundamental questions. Is the AI revolution a bubble like the dot-coms, or is it the genuine foundation of a new economic era? And as the economy evolves, the question of where interest rates will ultimately settle remains a central theme for investors. The unchanging truths. So, what have we learned from this 120-year journey? First, and most importantly, the long-term trend of the market is up. Look at the chart from 1900 to today. The Great Depression is a blip. World War II is a blip. The financial crisis is a blip. The long, upward-sloping line of human progress and corporate earnings overwhelms all temporary crises. Time in the market has consistently beaten timing the market. Second, the leaders of the market are always changing. The top of the market is a revolving door. Where are the railroad kings of 1900, the steel titans, the nifty 50 darlings? Many are gone, merged, or shadows of their former selves. U.S. Steel is not in the top 10. General Motors is not the titan it was. ExxonMobil, once the world's most valuable company, has been surpassed by Apple and Microsoft. The market is a mechanism for creative destruction. It relentlessly hunts for value and innovation. Third, the next dominant companies in 20 years are likely ones we are barely paying attention to today or that don't even exist yet. In 1990, Microsoft was a big company, but Apple was on the ropes. Amazon and Google did not exist. The future belongs to the innovators. So, what should you, as an investor, do with this information? Be an optimist. The doom and gloom headlines will always be there. But history tells us that betting against human ingenuity and resilience has been a losing bet for over a century. Be humble. Don't fall in love with any single company or industry. The market is dynamic. Diversify. Own a piece of the entire market through a low-cost index fund, for example. That way, you don't have to pick the winners. You simply own them as they emerge. And finally, be patient. Ignore the noise. The stock market is a device for transferring wealth from the impatient to the patient. Our entire journey proves that. The story of the stock market is not a story of numbers and charts. It is the story of us. It is the story of people building, creating, solving problems, and striving for a better life. And that is a story that, despite all the turmoil, always has a happy ending for those who stay for the entire book.